Hey, everybody, and welcome back to the Teaching Tax Flow podcast. It goes without saying, Happy New Year. We're here into a completely new calendar year. And we know you got questions. So, hence why we're here. Episode 169 today. We are going to look at the 2026 changes to charitable contributions. So, you don't want to hear it from me. You want to hear it from my co host, I promise you, Chris Pacuro. How's it going, man? Welcome to the new year.
Yeah, happy New Year. It's going well, and I was very lucky to have some time with the family. Especially that last week of the year, we traveled up to Chile, Michigan to see family, and then got to spend the last week in Orlando. No theme parks. We don't. It's funny, Mark. We've been there so many times. Our family, we like to do other stuff. And I went to near the theme parks like Disney Springs and then the City Walk. But actually, one of my team members from our private CPA firm was down there with her family, so that was awesome to see them. That was just a coincidence. But it's good to be back here in historic and beautiful Franklin, Tennessee, and good to be communicating with our Teaching Tax Flow community. I am really excited about this year, man. Sometimes you need a reset. It's almost like when your phone gets down to 1%, 2%, you almost got to put it in airplane mode and put it on the charger.
And of
And
course, you wouldn't, you would never fail to start this episode, right? We're talking about charitable contributions or charitable deductions, as we say. Of course, you're going to talk about nicer weather. And, once you send some charity up here to Michigan because I'm freezing my what off. So I'd appreciate that. But,
oh, I know it's
anyways,
chilly. I know it's chilly up there, and luckily we are having a great week, sunny, in the Nashville area. But it can get squirmy during the winter time. But we're excited about this, and with OB3, One Big Beautiful Bill Act, this is the biggest overhaul to our tax code in about a decade. It's 2026 now, and the Tax Cuts and Jobs Act of 2017 seems like yesterday, but we're thinking, like, gosh, that's 9 years ago. That was at the end of 2017. It was at the end of 2017, but still, it's been a hot minute since that law passed. But some of the One Big Beautiful Bill Act changes are going to apply to 2026. We wanted to get this specific deduction change out as soon as possible. As you know, I've taught the tax season updates for the National Association of Tax Professionals for the last few years, and these changes are things that were a surprise even to tax professionals. So now that we did a lot of tax planning, a lot of implementation here at the end of 25, we're starting to walk into 2026 and some of the rule changes, especially on charitable contributions. So remember, one of the laws of tax planning under Teaching Tax Flow that tax agencies are your involuntary business partner. Tax laws are written to encourage and discourage certain behaviors. So once we walk through these rules, we're going to realize that more people will be able to take a charitable deduction, but the amount deductible will be less, if that makes sense. So,
absolutely.
yeah.
And I mean, like everybody knows, right? We're talking about calendar years here. Usually with every calendar year, there comes changes. So I think this is a great topic, as you kind of alluded to. We're getting into just one piece of a lot that's going to be changing over this year specifically. The good thing is, right, it's through the One Big Beautiful Bill Act. At least we got kind of the preview of what's to come, right? It's not like January 1st hit and then all of a sudden you get slapped with a book of all these changes. But this one specifically, right? I think it applies to some, doesn't apply to others. But I think just having the general understanding of this one will, kind of goes hand in hand with what we always talk about, right? Tax planning. What might not apply to you today may in the future. So it's good to know this. Even if somebody's listened to this and they think, this isn't for me, I'm out of here. You'll want to listen. It's short, I promise.
And if you have a question, throw it into the comments of our YouTube channel. We're going to answer it for you. We're getting a ton of chatter on the YouTube, and if it's something that you want to remain anonymous, that's okay too. Jump into our private Facebook group called Defeating Taxes, defeatingtaxes.com. You can comment anonymously, ask questions. We actually have a weekly feature that you can ask the CPA a question. Just post it. And that's very popular. So yeah, let's start up with 2026. We're going to have a above the line deduction for people that do not itemize. So these are now in the since Tax Cuts and Jobs Act of 2017 came into the fray, about 90% of taxpayers do not itemize. What does that mean? That means they're taking the standard deduction. So if they were to make a charitable contribution, there was no, and we're talking on the federal side of things, there's no federal tax deduction. Well, for those people, you will now receive what's called an above the line. Above the line basically, or quite frankly, means it's a deduction you get before your adjusted gross income is calculated. And in 26, taxpayers who take the standard deduction can deduct cash contributions, so not non-cash. Oh, it sounds like a double negative. Cash contributions, cash or check. If you're single, up to $1,000. If you're married joint, up to $2,000. So let me run you through a couple quick examples. Let's say we have a taxpayer. Let's call her Emma. She takes a standard deduction and she donates $900 of cash to a qualified 501c3 charity. John, you and I are dog owners, so let's pretend it's the animal shelter.
Ooh, okay. I can follow that.
Yeah. So Emma, even though she doesn't itemize, she's single, so she gets up to $1,000 deduction. Now remember, guys, this is not just a standard deduction. You have to have evidence of your contribution. So she will get a $900 donation deduction. Not bad. Now think about another taxpayer. Let's say Tom and Laura. I'll make it Laura. They donate $2,500 of cash and they don't itemize. So they take that standard deduction. They're married filing jointly. Their deduction is limited of $2,000. And that extra $500 is not carried forward or it's not deductible. Like typically a charitable contribution gets carried forward if you itemize. But they would still get a $2,000 federal tax deduction. So there's some planning involved, and this starts in 26. So if you're someone that, let's say you're a married couple and you donate $2,500 one year and you happen to donate $1,500 the next year, from a tax perspective, you'd be better off timing it a little better and donating $2,000 per year instead of having that odd or that kind of.
You mentioned something
up and
really,
down.
really important there that I won't make you say it again. I'll say it. The word timing, right? It's all about timing with this, right? And some people probably don't realize that, but again, that goes back to, what we always talk about, the planning aspect. You can't do a lot of these things off the cusp and, hope it goes your way. You're not the one that wrote the playbook, right?
Exactly. We're there to interpret it and use it to our advantage. So now let's talk about, those are the non-itemizers. Let's talk about the taxpayers that are itemizers, meaning they file Schedule A and they itemize their deduction. Now we expect that the amount of itemizers is going to greatly increase, maybe more than double for the 2025 tax year and then the 2026 tax year as well, compared to 24. Why? Because of the SALT tax deduction increase, that state and local income tax. Well, itemized deductions or charitable contributions are an itemized deduction. Well, this one, so if the last one put those taxpayers on Santa's good list, Santa's on vacation now, right? We're still.
He's in the Keys.
Yeah, he's in the Keys. Hopefully getting some exercise, getting back into shape after eating all those cookies and milk. But now, if you're an itemizer, there is something called a floor. Oh, usually a floor is bad for tax payers, but there's a 0.5% of adjusted gross income floor for itemizers that want to take the standard deduction. Oh no, now that kind of gets confusing, right? What a floor means, and we've seen a floor in many other things. There's a 7.5% floor on medical deductions. A floor means you only get to deduct the amount of the floor as an itemized deduction. So let's use an example. Let's say you have a taxpayer named Jack. He has an adjusted gross income, AGI. Now, John, I'm going to stop here. I'm going to stop and tell you this. People that are avid fans of our podcast know that marginal tax rate is way more important than tax bracket. This is an example of a marginal tax rate difference. So Jack has an AGI of $100,000. He donates $1,000 in cash to a charity. You used to get a $1,000 deduction if you itemized. Not so fast. That first 0.5% of the $100,000 is $500. He gets no deduction for that $500. Only the amount above that $500 is deductible. So he gets a deduction for only $500 of the $1,000 he gave away. That's a real bummer. Let's take a look at someone else, someone in a higher adjusted gross income. Remember, AGI is if marginal tax rate is our number one KPI, AGI is our number one driver of the KPI, right? Adjusted gross income. So many things come from that. John, we've talked about the no tax on tips, no tax on overtime, the senior deduction, the car interest deduction, student loan interest, college credits. Those are all based on adjusted gross income. So let's say we have Susie Sugar Mama, okay? She makes $800,000 a year, and she's generous, and she donates $6,000 to a charity. Let's say a church or synagogue, right? First of all, I want to know if she's single because I have a friend for her. She's bringing in 800 grand, but that's all right.
She makes a
Let's say
lot of money, and she's, charitably inclined, I guess,
yeah,
would be,
that's good.
charitably motivated would be the word. That's a good person right there.
We like her. Yeah. So
Mhm.
that 800 grand of adjusted gross income, she donates $6,000 to a charity. Here's the trouble for our sugar mama. Remember that pesky floor? 0.5% of 800,000 is 400 grand. So out of the $6,000 she donated, she's only getting a deduction of $200. And if she is in a, let's say, 40% marginal tax rate, that's 500. She's only getting a $500 tax benefit from a $6,000 deduction.
Which is very significant. And I think, as far as for what we're talking about here, right? I think people, I mean, this explains it a little bit. You can obviously get more information, but I think it's really good that people know this as they're doing it, because think about it, right? And I'm putting myself in Susie Sugar Mama's shoes here. Not literally, she probably wears a small shoe size, most likely,
Probably a smaller shoe
but
size. You never know, though,
she's
John.
definitely better looking. I'm thinking about it.
But 800,000, absolutely.
Yeah, but you could do anything. You could do all kinds of fun. I mean, 800 grand would make me look a lot better. Let's be honest. But putting myself in her shoes, right? And I'm thinking, all right, I'm making this donation with the expectation of getting something in return by way of deduction, which I've experienced previously. Say she's done this for a number of years. What a kind of a stab in the proverbial back, right? When it comes time, if these deadlines are filing, and she's like, well, what happened? No, I did this. You're wrong. This is what I put. It becomes a very emotionally, uh, I wouldn't say not unintentional, but it's just not a good mental state you'd be in with that. And you might not do it ever again. Right. So I think knowing what's happening beforehand and saving that surprise is great
Yeah.
for everybody.
For
For
her,
a
the
number of
timing
reasons.
might make sense if she's charitably inclined and she likes to donate $6,000 a year. She might be better off, and she would actually be better off donating $12,000 one year and $0 the next year, and $12,000 one year and zero from a tax perspective.
Perfect way to tie that in together.
Yes. Now, don't let the tax tail wag the dog, but that's just something to consider. All right. We now have a 35% cap on tax benefit for high income earning taxpayers. Those listening, I did use a air quote. High income taxpayers. So that means someone that's in a higher than basically a 39.6% tax bracket. Okay. So that means that you can only deduct up to 35% of your income as a charitable donation. And believe it or not, we have clients in our private CPA practice, and we have taxpayers that donate more than 50% of their income. That's just where they're at, and that's what they want to do. So let's say you have Joe. Let's say Joe is a high income taxpayer. Joe donates $10,000 to a qualified charity. The deduction is allowed, but his effective tax savings is capped at 35% of the $10,000. So if Joe's in the 39.6% tax bracket, I know we like to talk about marginal tax rate. Even though he's in that 39.6% tax bracket, his tax savings is kept at 35% of the $10,000. So I know that gets confusing. So and I didn't explain it as well as I would like in the beginning. The bottom line is this: the maximum federal tax benefit, no matter what your marginal tax rate is or what tax bracket you're in, is going to be 35%.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
And you mentioned that too, right? Like you guys have had clients and some people think like, oh, I made $1 million. I'm giving away, I'm giving away $1 million, giving away air quotes with that. Right. And again, that they kind of, obviously the timing is important, but then obviously there's the personal weight of, am I doing it for which purpose? Right. Or both. Right. So if you know that you're capped and you still choose to do it, it's just good that you know that there's a cap there. It's not saying don't do it.
And let me backtrack, okay? Because I don't think I explained it as well as I would have liked. Let's stop the process for a sec, not literally stop rest, but there's a cap on the percent of your income that could be counted as a charitable contribution. I'm going to talk about that next. The 35% cap is the amount of tax benefit you can receive. So if you have a $10,000 deduction to charity, the maximum tax reduction is 35% of that if you're a high income taxpayer.
Okay, I see what, and thank
It's
you for going back.
different
Yeah, I
than
kinda thought about it a little different too. So it's good. And honestly, like, I mean, this is me being totally honest too, as somebody who doesn't obviously know even a fraction of you do, is what you do. In your world, there's so many things that change, right? I think the best thing about you, and you could, I mean, I would say plug your ears, but you're co-hosting this with me because I don't wanna give you a big head. One of Knowing you for so darn long, I think one of the best qualities that you have is you can actually identify as a tax professional, you can identify when somebody else may be misconstruing what you're telling them. So take that as a compliment.
Well,
I'm
I
not going to
appreciate it.
package it and put it on your wall or anything, but it's a
Well,
good
I won't
quality
put
you
it on the
have, sir.
wall. Yeah, I'm not gonna put it on the wall because if they don't understand what I'm telling them, that means I didn't explain it properly.
Good.
So
But then you
maybe I gotta
actually
shrink
take the
myself.
initiative. Yeah, let's shrink your head down a little bit. But honestly, though, like, and that I think really comes down to even when teaching tax flow started, right? Like you identified a lot of these holes,
Mhm.
and then I wouldn't say half baked theories is not what I'm trying to say. It's the half understood strategies and all these things, right? Like when you explain them like that, you say it in a way that if you can make sense to me on something that I don't understand in your world, you're doing pretty good. Let's put it that way. I enjoy being the dumbest guy in the room, as long as there's 2 of us.
As
But
long, yeah, as long as you're not by yourself or your dog. So percentage in carryover. So cash gifts we can still can deduct up to 60% of your adjusted gross income, but there are new limitations on appreciated capital gain property. It's going to be typically 30% and it's sometimes 20% of your adjusted gross income. The excess can be carried forward for 5 years. So let's talk. Cash gifts are pretty straightforward. Let's say you have Sarah. She has an adjusted gross income of 200,000. She's charitably inclined and donates $150,000 of cash. Thank you, Sarah. Society puts you on their Santa's good list. 60% of the 200,000 is $120,000 deduction. She gets that deduction in 2026. The remaining 30,000 just carries forward. So cash gifts pretty good. But what we were seeing, and I think there were some people out there in promoting, hey, if you've got if you have appreciated property, let's say you have crypto that you don't really that you want to donate. Again, there are a lot of rules with that. Or let's say you have a piece of an artwork that you want to donate. You can get an appraisal on it and get a donation deduction for the fair market value of that artwork. However, that's going to be capped at 30% of your adjusted gross income instead of 20% or 60%. Bottom line is, if you have non-cash assets that you're donating that have a lot of appreciation, they just fall into a different bucket of limitation. And definitely talk to your tax professional about that before you make that donation, or make the donation. Good for you. It's just, we want to make sure we understand the ramifications. What we don't want our taxpayers having a false idea of the transaction that they're going to enter into.
right, or the 1-to-1 ratio is usually not the case. And actually, believe it or not, as we wrap up here, I talked to somebody over the holiday that was saying that they had to get to Goodwill or was asking about the hours because they had to go drop a bunch of stuff off. I have a feeling that he was doing it because his wife was out of town and he was getting rid of a lot of her stuff, but I didn't ask questions. Somebody I see all the time. Um, and I didn't have enough time to ask him if he thought about it this way, but I had a feeling after the fact that he thought he could take this to Goodwill. They're going to tell him how much it's worth, and that's part of a refund that he's going to get, which is completely incorrect. So
Right. The value of the non-cash items will be a deduction if you itemize, and that would mean, and then whatever your marginal tax rate is. So if you gave away $1,000 worth of clothing items, assuming you could even deduct that entire amount, and assuming that you itemize your deductions, if you're in the 24% marginal tax rate, your tax would be reduced by $240. And you might have a cleaner closet. So that's a good thing.
that's the important part. I think that's what he was after.
Well,
Awesome.
let's run through. So 2026 charitable donation deduction changes for individuals. Remember, we've got the new above the line deduction for non-itemizers. We have the new 0.5% of adjusted gross income floor for itemizers. We've got a 35% cap on tax benefit, and we do have percentage limit changes and carry forward changes that really apply to that capital appreciation property. And guess what? We have something coming to you soon. Definitely follow all of our socials. We are going to have some live events coming up. We're going to have a live event in the very near future on YouTube Live, because we know that, once the Super Bowl comes around, there are a million ads about tax preparation. The live YouTube event's not going to be about tax preparation. It's going to be about making sure and empowering you and allowing you to get the best result possible. I answer any questions you have. So
That's perfect. We're working on a couple projects. One of them's been a couple years in the making too, but we won't give any hints to that one yet. So it's a lot of stuff, but it's a new year. New goals for teaching tax law as a community, I think as a whole, but then also, I think they align perfectly with, the changes that we're seeing here, right? Like we've seen changes get introduced and like I said before, the previews, right? Through OB3 and all these things that we knew were coming our way. And now we're taking those and expanding on them. And again, the content really is derived from our community. So we appreciate it. So a couple quick things before I let you guys go here. One of them, defeatingtaxes.com. Where is it going to send you? If you don't know, that's your invite to that private Facebook group. Check that out. It's always growing. It's made up of taxpayers, tax professionals, a lot of people around there. Great platform. Mentioned a little earlier, great place to ask questions. YouTube, check that out. Just teaching tax flow. You'll see all kinds of stuff. I think we don't have a ton of followers, but I think there's almost 5,000 people on there, which is pretty good given
a lot of
the
people.
content here. And we
Yeah.
get hundreds and hundreds of thousands of views, which is awesome to see too. And that tells us again what content people are interested in. And we expand on that. So we appreciate it from everybody. As we're wrapping up this one here, we're going to click over next week. We're going to be in episode 170. Which we're getting up there in age. So we've been doing this every week for a while, and we're going to continue to do it, right, Chris? We ain't giving up.
Absolutely.
It's not like we turn 200 and we retire from the podcasting world. So we got good things going. Awesome, everybody. Well, again, appreciate you joining us here. If you're listening to congratulations. But if you want to really watch two guys, me and this guy across the screen from me, go at it here and banter back and forth, check us out on YouTube. Every one of these are on there as well. So as always, welcome, though, to 2026, and we'll see you again next week here on the Teaching Tax Flow podcast. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.